Ladies and gentlemen, good evening. This is Christopher Aaron. It is the 4th of January, 2017. Happy New Year to everyone. A few days afterward, I hope everyone had a nice set of holidays. And we are going to look at some of the lessons that I have learned from this year in the precious metals. As you know, the point of this channel is to really just give you as clear of a vision of what is happening in the markets themselves with a focus on the precious metals, trying to cut through some of the rhetoric that appears quite often from both groups of extremists in these markets. I would say the pumpers, those who are constantly saying that the metals are going to $3,000 for gold this year, and also to provide a counterbalance to those people saying that perhaps gold is falling all the way to $400 this year. So I like to do the market analysis as I am being shown it from the market itself, and to try to cut through some of that rhetoric. So we will look at that today and put everything in perspective. Now, just beginning by the numbers here directly, let's take a look. The last 4 years, gold, it was down 28% in 2013. Gold was down 2% in 2014. It was down another 10% in 2015. 3 years in a row of losses. And 2016, despite all the volatility, the strong first half and then the weak second half, despite that, gold finished with a gain of 9%. Of course, these numbers are slightly rounded. 9% for the year for gold. Looking at silver, silver was down 35% in 2013, 20% in 2014, 13% in 2015, and this year, the first positive gain for silver in the last 4 years. So I do believe that this is significant. If you go back to the videos last year, I was debating whether or not 2016 would be the final low or whether we would see the first gain for 2016. And sure enough, we did see the first gain. So the lessening here in the rate of the decline was sort of foretelling that a trend change was going to be occurring here. And sure enough, we did have that. Now, we'll put that into better perspective as to what that may mean going forward coming up. Now, as most people here know, I focus on the numbers and the charts, and I do, however, pay attention to the fundamentals. I try my best to observe as many of them as I can. I simply recognize that as a human being, myself, and as any single human being, we are incapable of knowing all of the fundamentals. If anyone thinks that they understand all of the fundamentals, they are either trying to deceive you or they themselves are being fooled, because the markets are the sum of millions of individuals who are each thinking different thoughts. So I understand that we can't know all of the fundamentals, which is why I pay attention to the charts so much. That said, there are some important fundamentals that I observed this year, and I want to share those with you. The first one for the precious metals was the settlement by Deutsche Bank. I think this is really significant. Gold and silver. Deutsche Bank was accused in a lawsuit of manipulating the prices of the precious metals, and they agreed to settle before that case went to trial. So, I mean, the settlement was only a slap on the wrist in the grand scheme of things, about $100 million that they had to pay. But this really opens the floodgates. There are still 5 other banks that are being sued. And furthermore, the suits that are ongoing right now are by futures traders. So, for example, if one of the suits here against some of these banks that remain, if they're found guilty, imagine what could happen. You could have groups of options traders begin to sue Deutsche Bank. You could have private investors begin to sue HSBC. You could have mining companies sue the banks. So this is really something to watch as we go forward in the next year. I think this was really important here. And let me just get my pointer to show all the time. Thank you. The next major set of things that we're talking about here are really the political shakeups that we saw this year. Of course, Brexit being the first one in June, really surprising much of the mainstream media and shocking a lot of the analysts who did not see this coming up until the election. Of course, Prime Minister Cameron resigning as a result of this. Then we had in November the Trump victory, again, not predicted, Trump not being endorsed by any mainstream media outlet, and I am not endorsing Trump or Clinton officially. Unofficially, if you want to have a conversation with me, maybe I'll give you my opinion at some point. However, this is more just to say that the mainstream media and the mainstream political establishment was really kicked back a major couple of steps here with these two elections. Trump, the first president to never be in any political office prior to being elected president. So that is major, if you ask me. And third, not to be forgotten, the referendum vote in Italy in December, where Italian citizens rejected the prime minister's call for a referendum of the Constitution, which really would have helped the government to pass laws in Italy that would have been favorable toward large institutions and banks and a number of other topics. Taken as a sum, these three votes here, if you ask me, what is the main message that we are seeing here in 2016 from the political landscape? It is really quite an anti-establishment sentiment that is really going mainstream in the world. And this is unprecedented. I mean, the level of negativity that I saw in the Trump campaign here today, the level of rhetoric being thrown back and forth regarding the Brexit vote, I think we're really living through something unprecedented right now as people begin to come out and say that we are tired of the mainstream, the false left-right paradigm that we have been presented with as the only two options for voting for the last 2 generations or so. So this, I think, is going to have a significant impact on the precious metals and on the currency markets, maybe not immediately, but over the next couple of years. I mean, think about this. The combined population of the United States, Italy, and the United Kingdom is roughly 450 million people. So if you have these major votes where people are coming out and saying that we are distrusting the establishment political system, imagine if only a percentage of those people, instead of only voting at the ballot box, actually went out and made the next logical step, which in my opinion is to vote with their pocketbooks. Because the truth is that the left-right paradigm that's being presented is mostly false. Because after all, the central banks are controlling the flow of capital no matter who gets into office. So imagine if of the 450 million people, this is just the sort of simple example that comes into my mind. Of these 450 million people, imagine if 10% were to go out and say, I am going to buy some silver or I'm going to buy some gold. And you have 45 million people each buying 100 ounces of silver or 1 or 2 ounces of gold. The precious metals market just cannot handle, especially in the silver market, could not handle that. And it's really the next logical conclusion to have people who are saying, I distrust the establishment political system, to then go out and say, I distrust the financial system. Because the bottom line is that the financial system is controlling the political system. So I think there's a lot of potential for this to represent kind of the turning year, 2016 being the turning year, as the beginning of anti-establishment political voting going mainstream. When will that carry out into the precious metals? Well, let's look at the major asset classes for 2016 here. This is what I tend to follow to stay on top of the day-to-day across broad asset classes. We can see silver finishing in these 6 asset classes toward the top for the year. The U.S. stock market finishing just under 10% here for the year, the S&P 500. The CRB commodity index, this is an index of over 30 different commodities coming right below the stock market. Gold finishing right up in there, just around 8.5% for the year. U.S. dollar finishing higher by 3.5%. And long bonds, something that I've been paying very much attention to for the last year, finishing lower for the year. If these bonds continue to drift lower, I think this is going to represent a sea change in the investment landscape. You've basically had bond prices moving higher for the last 36 years. And if they start to move lower over the next year or two, I think you're really looking at a major trend change in the bond market, which is going to impact everything else. Now, to zoom this in, we're looking at here the breakdown of futures contracts that are traded on major exchanges here in the United States. So we're getting into a lot more detail than the last chart showed. And what you can see here is some of the leading commodities, even above silver, for example, ethanol finishing at a positive 46.8% for the year. So the best commodity, heating oil finishing up by 35%. And then fourth here was Brent crude at just under 28%. So all in all, it was the liquid energy market that was finishing very strong for this year. Of course, this is after oil prices had fallen 70% over the last 18 months. So you're really having a rebound here in the liquid energy complex. And then on the downside, some of the agricultural commodities, chocolate, rough rice, and wheat contracts finishing fairly low. The British pound finishing as the worst currency basically after the Brexit vote. Most of this drop happening in one day, amazingly. Now, what is not shown here, interestingly, is although precious metals themselves are shown, if you were to throw up a bar chart of one more asset class, can you guess which one that would be? This would be the representation, not included on most people's radar screens, the precious metals equities. For this year, finishing 74% higher. So it would have blown everything on this chart out of the water. We're getting into, of course, a specialty sector here in the economy that most people have next to zero interest in at this point even. However, this is significant to note. Major outperformance here in the equities of the precious metals as a sum. Let's get rid of that. And let's zoom this in now and look in more detail at the precious metals over 2016. As we said before, we had these rises in gold and silver at 8.5% for gold and silver 15.5%. And these were the outperformances from the equities that we were talking about. Now we're dividing them into the gold large cap equities and the silver large cap equities. So you can see this major outperformance here. Now, mind you, no one achieved these exact performances, myself included. I had some equities that were up more than this and a number that were up lower than this. This is if you were to have bought on the first of the year and sold on the last trading day of the year, the 30th. So, of course, no one achieved these index results, but this is an idea of how the sector as a whole performed. So you can see the major outperformance here and the silver equities outperforming the gold equities, of course, as silver outperformed gold, which is generally what we expect in a rising precious metals environment. Now, this leverage that we saw from the precious metals equities, here's an important point to remember if you're considering the precious metals equities, or if you're considering silver for that matter, to overweight silver over gold. No leverage comes for free. Okay, so if you're a precious metals investor and you're debating between gold, silver, and some of the equities, how to allocate, you have to remember that even though this is what was achieved during an upcycle, an up year overall, you have to remember that leverage does not come for free. So some other examples are if you were going into the futures market and you were buying a leveraged contract and you're putting 10% down, and the brokerage is fronting you 90% of the contract so you could make 10 to 1 off of your investment, that opportunity for 10 to 1 does not come for free. Because why would the brokerage loan you money for free? They're charging you usually 6, 7, 8% interest in order to make that leveraged bet. Another example, a lot of people use the leveraged ETFs, which you have to be really careful for. The JNUG or the Nugget, and there's a lot for gold or silver, USLV, for example. You have to be really careful for these because that leverage does not come for free. You pay for that leverage even though you don't see it. You're paying in the management fees. You're paying in the tracking error that these funds have. So, where do you pay for the leverage here in the precious metals, equities, and in silver? You have to zoom in on the downside. You have to go, okay, when there's a correction, so we're going to zoom in on this basically from August, what happened as the sector was moving down? And you can see, so if you're favoring silver over gold, you have to be prepared that on the downside, you are going to be paying in the leverage down with silver. So it works in both ways. Gold is more stable when the metals are falling in general than silver is. Okay, now there was a really interesting thing that happened here, however, when we look at the equities. And basically, what we can see is that since the August decline that started in the precious metals, the gold equities and the silver equities basically fell almost in tandem. In fact, the gold equities were falling more than the silver equities right up here, and they finished within 1 percentage point even. And this is as silver fell more than gold. So I would say if you were considering the equities at this point, and if you're doing your own research as to what companies to invest in and studying the charts and learning about the mining fundamentals and all that stuff, this is very interesting. Basically, you got the massive outperformance in the silver mining equities, but you did not have to pay for that through a leverage to the downside in the silver mining sector. So this is going to be impacting my decisions over the next year, and it may be something that you would want to consider as well as we move that back and you see again what I'm talking about. So the silver equities outperformed on the way up and then fell in tandem with the gold equities, even as we see silver maintaining its lead over gold for the year. To back it all out, the important thing that we are looking at here as we start into 2017, and now we're looking at the chart of gold from the year 2000 to the present, just back everything out, and we are really taking a look here at the bottoming process that is coming into play here for gold. We saw this primary channel broken here last February. This looks really nice, like it's coming back and has just hit that channel. And even though there could be some more grinding type of action here, these were the support levels that I had identified about a year and a half ago as gold was still making some of its final lows in here. And these 4 levels basically give you a swath of support here in this green zone, basically defined by the 1980 former all-time high and going up to that 2008 to 2010 horizontal support. This area, although this is not an area that would be suitable for entering a trade or a leverage trade, if you're looking at this from a long-term perspective, which is, I think, very important to do to really get the pulse of the market, you had a market that had come down for 29 years, broke above this level for good in 2009, and has now come right back onto this level. So this looks like a very, very logical spot where gold is looking to put in a major long-term bottom above the 1980 high. I think that would be the most important thing to pay attention to here over the next 12 to 24 months, even if there are new nominal lows in price, which would scare out most people who only became interested here in the last 6 months, but it would still represent a very excellent long-term basing pattern to get ready for a new move to a new high. Switching over to silver, and we can see here the silver market. This is that decline that we were talking about in the very first slide, that wedge. You saw the lessening of the declines, breaking that, coming back down to the linear rising trend line here, showing the magenta color. And mind you, this is happening all underneath the 1980 all-time high. So silver is massively undervalued still relative to gold, even though if you are a silver investor, you basically have to get used to this for a period of years. You can't expect that in any 1 or 2 year period, silver is going to catch up to gold. This could take a lot longer to manifest than some people expect. That said, I think if you have a real long-term time horizon of in the next 4 to 5 years, I do expect that silver is going to catch up, and eventually, just like with gold, the 1980 high, I believe, will be acting as support for silver once it breaks that and begins moving above the $50 level, just as 850 did for gold. Move silver back out of the way. That said, if you are a silver investor or an equity investor, you have to pay primary attention to what the price of gold is doing. Nothing else is more important to pay attention to than the actual price of spot gold, including the manipulation, including the banking shenanigans that are going on, including all of the trading activity in the paper markets. This is what is going to set the silver and the equities on their course. So we will pay primary attention to gold and secondary attention to everything else in this channel as we move forward into 2017. I thank you for watching. Have an excellent 2017. The services that I do offer for those who are interested are premium research that comes out every week. We cover the physical precious metals, gold, silver, the GDX, the individual miners, buy and sell signals that I'm using for my own funds myself. And I also do individual consultations by voice and email for those individuals who have unique situations that require a researched perspective from someone who does not sell the metals and will give you at least an unbiased perspective on your situation. Thank you again, and I will see you this time next week. Have an excellent 2017.